The markets right now are reflecting the maturity or the maturing of an oil and gas sector in the U.S.
In 2022, I was shocked at the upside there where it spiked, and specifically the times that it spiked. It was like in the shoulder months it started taking off, and it was like, this is weird. It felt fake, but now with it as low as it is, kind of almost feels artificial as well. It's like, this can't be sustained. And
so we have 350 producers or so that are customers, and we have insight into what their production volumes are going to be, because you really need to know production volumes in order to come up with a hedging strategy. This year compared to past years is that hedge percentages are lower than they used to be. 2012 through 2019, demand was growing at this great pace, and then I know COVID got in the way there in the meantime. But what do you think it's going to do this year? Is it going to do 1 million barrels a day, 2 million barrels a day? Does the forward curve reflect economic reality? No, there are some real big discrepancies out there.
My name's Max Gagliardi, and this is Always Be Building. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow me on your favorite podcast app. Hope you enjoy the show. Matt, welcome to the podcast. Thanks for coming on. Yeah. It's the borrowed studio. I guess it's not really borrowed now because I'm working at AEGIS, and this is a really nice setup you guys have here.
Got all Brian's Pearl Jam posters from all his concerts.
It's pretty sweet, and what's even more sweet is the fact that you're on the team, and not just you, but your whole team. I love to nerd out on the market and analytics, and historically it was me doing a lot of my own research or trying to figure stuff out whenever clients or people would have a question. I'd do podcasts with folks that would bring insights, but the fact that you and the team are here and can just reach out to you guys and have that as a resource is huge. So why don't you just introduce yourself to start, and let's dive into some topical discussion on what's going on.
Sure. Yeah, same bet right back at you. I mean, we're joining up this physical analysis with financial analysis to complete the chain. I used to lead research here. I built this team, and I came over from mostly proprietary trading, so it's speculative trading. So you're just trading for your own profit. Now I worked for a global team where we had a derivatives desk, and so they're actually a counterparty to a lot of our customers' trades now. But it's just a different world when your job is to analyze the market to make the right bullish or bearish call, and what type of trade do you put on. Now, the nice thing about that, though, is that type of analysis translates very well to an oil and gas producer who's trying to make a decision about hedge timing and pricing, and how do you do that wisely. And you use a lot of the same principles in trading when you're trading for your own profit that you do when you're trying to trade over the counter or bilaterally with a bank. So it translates really well. And what we found is that our customers like to hear that insight that happens behind closed doors on a trade floor among analysts who never publish, don't tell you how they do things. They're the best in the world at what they do, but they're never going to tell you how they do it.
Yeah, that's good. What you've been through a lot of cycles, and you've been studying the markets for a long time. Is there an analogy for right now where this period for oil and gas reminds you of other times in your career? Is this like, there's been a lot of ups and downs. Obviously COVID hit, and then 2022 was crazy, specifically on the gas side and oil when the energy crisis in Europe. But just like a pulse check, or just what's the vibe check, I guess, right now on the markets versus what you've experienced in the past?
Yeah, the markets right now are reflecting the maturity or the maturing of an oil and gas sector in the U.S. Let's say that this unconventional oil and gas production approach probably kicked off in earnest probably 2007, 2008, and then oil borrowed that technology and really started doing it in 2010. And wouldn't you know it, it was Chesapeake both times. It was Chesapeake in the Haynesville, really, kind of the Barnett, but then it was Chesapeake in the Eagle Ford trying to test that technology there. So here we are, call it 14 to 16 years later, and the industry is maturing. And what do you see when an industry matures? You see margins starting to get thinner because supply becomes more predictable. You start to see consolidation, where the companies that have great rock and great performance get bought up by the more established, better scaled, larger producers. I think that's what we're seeing. So that's what you're seeing in industry. And then in price, you're seeing the same thing. So what would you expect in a mature market? You would expect that the price of the commodity to start to approach the marginal cost to produce it. And wouldn't you know, that's what the forward curve looks like right now. Let's just take natural gas. Just take natural gas. So let's leave out oil producers for a second because that kind of clouds the issue. But if you're a natural gas producer, what type of price are you facing? Well, for this summer, it's a little over $2. It's recovered a little bit, but that's getting dangerously close to the variable cost to produce it. In fact, what have we seen when prices dip down below 2? You saw announcements that some gas producers would curtail production. So that's in the near term. It's saying prices, if they drop any further, we have too much supply. If they drop any further, you might see supply get reduced. Well, go out into the curve, go out to next year. What do you see? You see a price that's around 330, 350, something like that. That sounds like about, and our customers tell us this, that's about the price that you need to justify the drilling of a new well. So here we have a forward curve that's sitting right on top of what we call break-even economics, both for PDP, existing produced gas, and new gas.
Yeah, gas is one of those things where it always feels like over the years that we're going to get, because for the reasons you mentioned, that we're going to get some sustained breakout, and it will be maintained. And, they call it the widowmaker for a reason, but it just seems like it just continually gets kicked. The big question, and I've got a lot of clients and friends that work at E&Ps, also have friends that run midstream companies, and it's kind of like, where could this equilibrium price shake out to be, or we're just going to always be whipsawing like this? But just your thoughts on, does it ever stabilize it, or is it going to continuously be in this? Do we have so much supply that Chesapeake drilling all these ducks, and then as soon as it, we see a little recovery, it just gets crushed again?
Well, that's been the pattern over the last 15 years, is that you have supply can grow very quickly. I mean, the cycle time on a new well used to be, like, say, an unconventional well, say in 08, 2010. Maybe the cycle time on that would be something like from the time you approve the expense to the time you see gas, might be 15 months, something like that. And I think that time has shrunk down quite a bit, but still, that's really fast when you consider how long it takes for new demand to show up. Because when you're building new demand, what do you have to do? You have to build a new power plant, a new LNG export facility. I mean, that's a multi-billion-dollar decision. Power plant, yeah, siting. But with power plants, you got to site them. You got to, get all that regulatory done. It just takes a long time, and it's a much more complicated, larger project. And so what we've seen is, you can see that the demand is coming. You know when it's going to arrive. These are long lead time projects, but the production can get ahead of it and produce too much. And so you see production go up, price go down, the demand shows up and price spikes. You produce more into it, hedge it, produce more into it, and then you overproduce again. And I think that's the cycle that we're starting to break now as the industry matures.
Do you think that the producers being hedged is, because, you'll hear a lot of chatter around people are going to start shutting in, and this is, this can't last, but how much of it is, as a percentage of the, I don't know if we know this number, but of the 100 BCF a day produced, it's how much of that's hedged, and are people just kind of rolling with it right now because they're we can do it? I don't know if we have any sense of that, but it just seems like that could be something that perpetuates it, because folks are I'm hedged in, so I'm just going to let it flow.
Well, first of all, we benchmark that. So we have 350 producers or so that are customers. And so we have insight into what their production volumes are going to be, because you really need to know production volumes in order to come up with a hedging strategy. You don't want to be under-hedged or over-hedged. So we get a sense of that. I'll say that this year compared to past years is that hedge percentages are lower than they used to be. And there's several really good reasons for that. One of them, and first of all, I would like that they were more hedged. If you look back at our research that we've been publishing for the last 2 years, it was 2023, 2024, big warning years. We are bearish, no equivocation. You should be hedging this. Let me show you how. Fortunately, some took us.
I talked to an AEGIS client today, and they're interested in physical, but they made that comment. They're I wish I would have listened to them about they're they do a great job, but I just wish I would have listened more on hedging some of these gas volumes this summer, is the comment that they made.
Yeah, I don't like being right about that. A little. I like being right a little bit, but yeah, you wish that it. So anyway, I think that we did have good visibility into that and properly identified the risks. But going back to your original question, could you restate it for me?
Basically, is this going to be this volatility? It always seemed like at some point there would be a floor, and it felt like that needed to be $3 basically, and that 275 to 350, some range bound, and it just seems like when we get into these periods where it's below $2, it just everything seizes up. People can't make decisions. They don't want to do acquisitions. They don't want to, it just makes it harder to operate a business when you're in this kind of volatility. I also think the volatility to the upside was unhelpful, because if you're trying to sell an asset or buy an asset and prices spike to $6, $9, it's like your models are broken at that point. So it's like, will we ever get to a sustained, less volatile, future? I mean, I think like there obviously hasn't been a lot of new storage built, but is the storage that could maybe smooth out some of this, but like, is the new storage just ducks? I mean, I don't know. It's kind of an open-ended question.
I think there's a lot of truth in that. So will we stabilize on a price? So next year might be a real good test of that. So let's think about what a producer was facing. Trying to, say you're a gas producer, you're trying to position your company, knowing that demand was likely to be really soft in 2024, yet there's a lot of new LNG facilities, new export that is coming online in 2025, 2026. So if I am if I'm on a board or a CEO or CFO and I'm trying to plan and position the company for that, I've got a tough decision to make. Do I invest in 2024 for the expectation that 2025 might be an outstanding price year? Or do I wait for the price signal and then drill into it and hedge it, and then maybe I miss the first part of it, but I catch the majority? That's a really tough problem. That's a tough problem. And if you look in history, except for 2022, in the last 15 years, I would say that you've been taught not to wait for the price signal because it only lasts for just a second. So instead, assume something. I'd say that as the industry matures, these decisions are going to have to be made more like, now that I've reduced my debt, now that I have, say, lower G&A, now how much can I produce into a price that has been more like the average over the last several years, and forget about the spikes?
Yeah, it's a tough one. I think also this associated gas in the Permian and just how much that's pushing. Does the consolidation? Do we have a view at all on the consolidation there? I know we've talked in the past. I've heard some chatter internally around, okay, well, these folks are consolidating. They're going to maybe slow some activity. Is that going to make a dent at all in the associated gas, or is it still just going to be, because it's almost like it's just a waste product in a lot of these areas, and we see it on the midstream side where the deducts are eating up all the value. It's just they're not even focused on what the gas markets are doing, and so but it's obviously impacting the gas markets in a big way.
We definitely hear that from customers. So here's the thing I would say is that if oil price is high, and let's just call it like mid-70s and beyond, gas is a waste product. If oil prices is low, gas is a revenue stream. It's like the attitude toward it changes really quickly. I mean, the last couple of months when gas, not just near-term gas, but gas for 2025, prices have been coming down, we get a lot more calls from oil producers because now, as a percentage of revenue, it's becoming more of an issue. I mean, thankfully, we've had a nice little rally in oil too. Here's what I think about the consolidation. What's going to affect us? How is it going to affect associated gas? There's a near term, and then there's an ongoing. In the near term, I think the consolidation has been too recent. And so a lot of those capital plans that had been put in place 2 years ago and last year the gas is showing up. So in the near term, somebody shouldn't be interpreting that we're going to have a supply shortfall this year or next year. Beyond that window, I think that's when it really starts to show up. Production rates start to slow down, and you start to see something grow within demand.
Well, it'll be interesting. You always hear this inventory woes in the Permian and how real that is. There's some people that are still very bullish. It seems like always we're getting surprised, at least in my career, on how much is out there, like whether it's oil or gas. And for gas specifically, we're just in this anemic, I'm always let down because historically we did have more exposure. We still have some to the physical price, but I just joke around. It's like it was always real to me because our revenue would be impacted by that. And so some folks that maybe you're an equity investor or whatever, they have some exposure in their investments to it, but for us it was real. And so I just I'm always interested to talk about it because I always want to be a bull, but I just always get kicked for being a bull. So Yeah, it's hard to get bullish. I wish I could get bullish on it. The LNG that's coming on, it's massive. I mean, what are we talking about in terms of order of magnitude of new demand for exports?
Yeah, I think it depends on the time window you look at, and the start times are a little questionable. And I've got a colleague that's hiding over there. Hopefully, he'll correct me if I get this wrong. But think about it as around 5 BCF a day on average across the year that's being brought in for the next 2 years. So let me size that up, because I think a lot of people hear 5 BCF a day and they're not oriented or calibrated mentally to think about what that is. But U.S. production right now depends on how you measure it, but 102, 103 BCF a day. And so 5% additional demand, growing that market by 5% in 1 to 2 years, that's a lot. Yeah. That's a whole lot. I would say that it'd be good for us to put out a little piece of analysis to show what 3 BCF a day or 2 BCF a day of supply demand discrepancy would do to inventories. And what you would see is that over the course of a year, 2 BCF a day could either send gas, if you had too much gas, make inventories completely full. And if you had too little gas, it can make them essentially completely empty. So that's the scale we're thinking here. So instead of 2 BCF a day, we're talking about 5. So there's a big question about, will there be enough supply to fill that? And the producers are like, oh, well, are all my peers going to hold back production too? Because if everybody doesn't grow too much right now, kind of like the way Chesapeake's describing and Range and some other gas producers, then next year you could see some really exciting prices.
Do you think, I'm trying to think of the best way to ask this question, but when you look at the futures pricing for gas, does it match up with how you feel the fundamentals look for supply and demand, like all this new demand coming on? Or when you look out into the future, are there things that look like irregularities, like in that strip price? So you're like, this seems like it fits where we're thinking for this time period, but this time period here, I'm like, is that a good way to ask that question? I mean, what do you think about what the future pricing is?
Yeah, it's a really insightful question, because basically what you're asking is, does the forward curve reflect economic reality? Right. I would caution anybody who looks at a forward curve and thinks about it as the market's forecast of prices to stop thinking about it like that. It's not. The way the forward curve is shaped has as much to do with storage and spread traders and the interaction between hedgers and speculators than it does with economics. The forward pricing is more of a negotiated transaction price. It's not really meant to be the market's prediction. And we could probably do a whole other, conversation about how that works. So to answer your question, no, there are some real big discrepancies out there. So the big question right now, we talked about 5 BCF a day around that of new LNG capacity coming on the next 2 years, call it. Is there enough gas production to fill it? If not, then next year's price that's been hovering around 330, 350 is way too low. Way too low. But, and I tend to go that way. I tend to think that way, that especially since prices are low now, investing in next year's gas is really difficult. So I tend to be bullish. But there is a bearish story to tell too. And here's how it goes. Right now, the market is oversupplied by 1 or 2 BCF a day. 1 to 2%. So that's gas that is not needed. And so we've seen some announcements of curtailments, like reduced supply. That supply hasn't gone anywhere. It's just waiting. So you've got that amount. And so you can kind of keep a running tally. Call that 1 BCF a day. What's happening this summer? New pipelines out of the Permian Basin. And it's not just gas pipelines, it's all the associated infrastructure with it. And that gas goes right into the Gulf Coast. That could be somewhere between 1.5, maybe 2 BCF a day on the high side. So keep that running tally. We're trying to get to 5, right? Plus, you have the possibility that gas production could increase in the second half of the year because of capital investments made in the first half of the year. How much are you going to get there? Last year it was about 1 BCF a day. So you can see that you start adding that up, and you could be balanced next year. And that means that the market needs to price at the marginal cost of a new well. Well, guess where the price is right now? About the marginal cost of a new well.
Yeah. It's we could talk about this for a long time, but let's move on to some other products. But before we go to oil, you did a good explanation earlier around basis differentials and what kind of drives those. We talked a lot about the mid-continent, and I think that's a question we get from folks, like what's Waha going to do? What's mid-con basis going to do? But just in the easiest, simple, elementary way to explain kind of what's driving those, I thought you did a good job. And so for some folks, I think they may not know. So just your thoughts on what drives those basis price.
Sure. The thing that the main lesson that I would ask somebody to consider about basis pricing is to not think about it just being a simple locational price. So if you're thinking about in West Texas and the Permian, either Waha or El Paso Permian, there's a regional gas price there. You can't think about it as a standalone price. You have to think about it as a network of prices that interact with each other. And the reason they interact with each other is because they're all connected by pipeline. And there are marketers who are buying at one and selling at the other. So if the prices get way too far apart, marketers will collapse that. If one price gets too weak, a pipeline company will announce plans to build a new pipe. So you have to think about it as they all work together. And so what that means is if you're looking at a mid-con price, you really need to have an opinion on what Rockies is going to do, Chicago, Permian Basin, Gulf Coast, and this will blow your mind, but it's totally true. You also have to think about what happens in Southern California and how much gas Mexico is going to take. You think, I have to worry about all that for Western Oklahoma? Yeah, you do.
Well, that's why people need to hire AEGIS to help with physical and financial. We'll put some plugs in here. I think there's a lot there, and hopefully we do more of these. We can talk maybe about some of these basins specifically. On the oil side, I mean, it's OPEC. I know you guys make the factor matrix. It's more than just that, but just what are you paying attention to in oil, and what are the main narratives people should be thinking about?
Yeah, it is OPEC. It is OPEC. And it's not the only thing that matters, like you said correctly. It's not the only thing that matters, but the truth is that if OPEC together chooses to withhold production, then this market is balanced to tight, meaning undersupplied. If OPEC chooses to return that oil to the market, they have enough held back that on the margin, it can make the margin oversupplied. So when I look at the way that oil prices have traded in the last, since prices came down after the Russian-Ukraine conflict started, it's been really range bound. Low price somewhere along 62, 65, and the high price being like 75, 80, and it's been in between that range. I think that really that shows economic reality, because what happens if prices go too low? OPEC reaffirms its policy of holding back production. If prices go too high, what do? They decide to let some come back into the market because they've got a market signal that there needs to be more supply.
What do you think on the psychology of OPEC? This is always kind of the fun conversation around. We knew during the early shale boom, it was market share and trying to crush some of this supply growth, which it's been pretty resilient. But now, there for a while, it was kind of this ESG narrative, and we thought, well, maybe OPEC doesn't think we can actually grow, or we're not going to grow. And then you hear people talking about, well, they've got, this is the break-even price really when you think about all the other spending that they have to do, and Saudi wants the price here. And there's all these different narratives around what their psychology is. Any just thoughts of what do you think they're thinking right now? I know you can't answer this question, but it's always fun to think about it because it does have such a big impact. There's like an election this year. There's all these things going on, and it's like, what do they really care about? And I don't know, just any thoughts on what you think their psychology is right now?
Oh, wow. If I knew for sure, I could make a lot of money.
That's exactly right. I've always kind of argued that they want higher prices. I know the market share argument, and there for a while that was true, but gosh, it seems like it's a finite resource. You'd want to flow it at a higher price. I just don't see them. I struggle to see a scenario where they, artificially keep it super low right now, at least. And it's certainly like if, OPEC plus Russia, they don't want low crude prices right now. The U.S. government wants low crude prices. They did what they could with the SPR.
Yeah, from time to time, we like low oil prices, yeah.
So that probably was annoying, but I just struggle, I guess, thinking that they're going to try to somehow cut prices a bunch or flow enough production to where prices just get crushed.
I think you're right. If you look back to 2014, 2015, the choices that OPEC made at that time, that was a different time. If you really think about it, that was only 4 or 5 years into unconventional oil production in the U.S., and it seems like OPEC had the opinion that low prices would reset the U.S. oil producer to think more conservatively about spending. Yeah. And it didn't work. And And we could talk more about how the maturity of the oil market in the U.S., but it didn't work, and I think they learned their lesson. And if it didn't work then, it sure doesn't work now. If you think about all the consolidation, one of the effects of consolidation is that the overhead cost per barrel goes way down, which means that the break-even price to produce oil goes way down. Now, at the same time, what OPEC has to like, and I have no idea if they were involved in this, but what they have to like is that boards and investors and boards are telling companies now to produce rather than overproduce, produce within a certain percentage range. And what that says is that the U.S. becomes less of a threat to OPEC over time.
Yeah, yeah. You guys have mentioned this before in some of our market update meetings, but I think a lot of people get caught up in the geopolitical risk premium and all the stuff going on, the turmoil in the world. I mean, obviously with the Ukraine war, there was some disruption there, and that actually showed up, right? Whereas like you see a lot of headlines, and it's like, oh, this is happening over here, and this missile got launched or something happened, but the price like went down, and people are scratching their heads. Like, I'd like your guys' take on it, which was more pragmatic. Like, is this actually going to do anything? Do people put too much, stock in these events, these headlines that they see, but they're not really translating into anything?
Yeah, well, I'd say they used to.
Yeah.
If you look at price response, especially since the Israel-Hamas conflict, the fact that there basically has not been a geopolitical risk premium baked into oil, not by our judgment. There's really no way to say for sure, but by our judgment, it doesn't seem that way. Then you could say that maybe the market has learned its lesson, and it realizes that whenever supply is threatened, it really doesn't last that long. And you should really discount it. If I had to mathematically describe the geopolitical risk premium, what it is if you think about all the things that could happen, and those few things that could happen, what would be the effect on price? Then that says that if you took a weighted average of all those scenarios, that you got to give it some credit. It's like, but what if this happens? What if I don't know what the scenario would be, but there's a really bullish scenario out there. And I think what we've learned over time is that maybe we were overestimating that tail risk. And if that's the case, then you're doing a weighted average of a much more reasonable set of scenarios. And of course, the price should stay more range bound then.
Yeah. Any thoughts on the supply or the demand side? We've talked about the supply side a lot. I mean, anything there that you're paying attention to, or is it kind of steady Eddie? We sort of think we know what it's going to do, and it's kind of tracking with that.
We do not know what it's going to do, and if anybody tells you what it's going to do, they're wrong. A good example is just this year and last year, what was expected out of China and in Asia at large. One of the big theories last year was that as China ended its zero COVID policy, I can't remember what they called it exactly, but they were basically still locked down and not allowing travel, is that whenever that travel was open, that the surge in jet fuel and road fuels would go back to normal. And it doesn't seem like it happened. I don't know exactly why, but it doesn't seem like it happened, and so demand really disappointed a lot of people. And what a lot of banks were calling for, $90 oil, and instead what they got was $70 oil. So, big question I get from customers all the time is like, hey, like 2012 through 2019, demand was growing at this great pace, and then I know COVID got in the way there in the meantime. But what do you think it's going to do this year? Is it going to be 1 million barrels a day, 2 million barrels a day? And honestly, I don't think any shop out there is going to give a great answer on that.
Yeah, it's hard to know. And then you've got like everything going on with the macro, not just in China, but here in the U.S. And I think last year it seemed like everybody was too bearish, honestly, on the macro. It's like recession, look at rates, like, this is this indicator. It always, maybe we're still heading for one, but at least at the beginning of this year, it seems like from the U.S. standpoint, economy's kind of chugging along. People were, maybe I'm just on Twitter too much. People seemed extremely bearish last year on the economy, but I don't know. Do we pay much attention to interest rates and the macro around the economy and all that stuff? Do you guys already focus on that at all?
I mean, we do. So how would I describe that? I mean, the macro environment is something you have to keep track of for oil for several reasons. One is demand. I mean, you already touched on that. Yeah. It's because of demand. If you're expecting economic output and GDP growth, then you're going to expect a predictable amount of petroleum demand that goes along with that. But there's another thing you have to pay attention to, and that is the effect of inflation, interest rates on currency. And currency has been a big part, as a big factor contributor to oil prices, and that's something you have to keep track of too.
It's interesting what's going on with the dollar. I haven't been paying attention to those indexes lately. There for a while when the inflation stuff was picking up, I was watching that. I mean, things I look at are I'll look at the 10-year. I do some real estate stuff, and so I'm always interested in what's going on there. But I haven't really been tracking with the dollar strength or weakness lately. I don't know if you guys are looking at that at all.
Yeah, sure. How about I do it in just like chunks of time, and that kind of lets you know where we are, how it's evolved. Is we had inflation and interest rates were not keeping up with that. But then whenever the Fed decided to step in and be really aggressive about interest rate increases, what that does is it creates a market that is attractive for people to own dollars. And so they'll want to buy dollars so that they can buy U.S. Treasuries or Treasury linked bonds in commercial space or wherever. So dollars get bought, foreign currency gets sold, and it increases the value of the dollar. So what's interesting about that, though, is that just the currency effect, the increase in the value of the dollar, tends to decrease the U.S. denominated price of a barrel of oil. So it pushes price down. But the broader macro economy, what's going on there? Why are interest rates going up? It's because the Fed is perceiving that they need to cool the economy and bring inflation into check. So they're basically saying that we're going to interfere with the economy and try to slow it down, which is, again, bearish for economy, bearish for oil demand, and should also push prices down. So you kind of get those two things working together. Now, what are we going to do? The thing to watch is at what pace is the Fed going to make decisions to reduce rates? It seems to be the direction they're going.
We'll see. I mean, it seemed like the market for predicting the rate moves has been a little bit off, and it's changing. And I don't know, with the current economic data coming out, it seems like the safer bet. I mean, people are arguing real yields are too high, given where inflation's come down to, but there's still a lot. It's kind of, things are hot right now. I mean, there's the job market. Until the labor market breaks, I think it may be tough for them to truly take their foot off the brake. I mean, I don't know.
Yeah, that makes a lot of sense. I wouldn't want that job.
Yeah. It's been an interesting one to watch. We don't have much time left. I know we've got a lot to do. I want to do more of these. Any thoughts on NGLs? Lastly here, before we leave, just what's kind of going on there? Have you guys getting questions on it from folks?
Yeah, watch out for NGLs. So there's two things to watch with NGLs. One is the overall price of crude. It's just there is a linkage there. We'll go into that later about how that works. But then, so that's kind of the tide that either raises or drops the NGL price. And then on top of that, the other factor is for each NGL, its specific supply-demand balance. Most people, when they think of NGLs, especially in producers, the larger revenue comes from propane. So we tend to talk about propane first. They all act independently, but we talk about propane first. Watch out for propane. If we keep seeing increased associated gas production, especially out of the Permian with these new pipes and just a continued investment in oil, you're going to see propane come out of that as a necessity. And we really don't see any big growth in propane until maybe like the end of next year, something like that. If anybody has any opinions about the timing of that, I'd love to have a conversation with them, because it sure looks like the near term is going to be tough on propane.
Yeah. Well, this is good. We will do it again. Certainly when I'm here, we got to get this Bliss is a Suite set up. Got to get it going. And then even on if we got to do it online as well. But just, I think that these conversations are ones that I really like having, and I think the guests enjoy it too. So thanks for making it happen.
My pleasure. It's good to have you here too.
All right. Thanks, guys.